Today we'll look at Unit 5, which talks about financial ratios or interpretation of the financial statements. In the previous chapter or previous class, we looked at the financial statements, how to come up with an income statement and how to come up with a balance sheet. Now, having understood those two, we now come to another important topic, which looks at what? Interpretation and an analysis of the financial statements. So the objectives here are basically to understand how to interpret a wide range of financial statements from various institutions. So financial statement analysis is very vital for a financial and non-financial student in order to help the business owners understand and help them analyze the data from the financial statements. It is also very important because it helps them provide them with better information for key decision making. Remember, firms will exist in an organization for three primary reasons. Number one, for profitability, to make a profit. Number two, for survival, to ensure that they survive. And number three, to have a large market share. So financial statement analysis is very essential because it helps provide information about the firm's current performance, past, and the future performance, thereby analyzing and giving you the gap that has been made, whether we are improving or whether we are declining in our performances. Financial statement analysis is also essential because it helps assess the organization's earning power, its potency, the quality and growth of this institution. These ratios also will help us come up with the solvency. How is this firm able to meet its debt obligations, whether short-term or long-term? It is also important because financial statement analysis helps to provide information for business survival. So tools that are implemented in financial statement analysis are four. We have the horizontal analysis, we have the trend analysis, we have the vertical analysis, and ratio analysis. Now, the horizontal analysis basically involves you computing the changes that occur from one item to another. It uses both the dollar or kwacha amount to the percentages. It looks at the amount, the change in the amount divided by the base year. For instance, if we want to find using the horizontal analysis, the change in sales for this company, we have 2017 and 2016. So the difference between these two is 1,500. So the percentage is simply the change we divided by the base year. So we divide the 1,500 over the 16,000. So meaning we have a percentage increase of 9.5. Whereas the percentage is a positive, it is an increase. Where it is in brackets, it's a decrease. So the variance between the net income from 2017 to 2016, clearly we are decreasing from 3,200 to 3,100. So the change from year 1 to year 2 is negative 64. So negative 64 divided by the base year, which is 3,200, gives us a decrease in the percentage by 2%. So this is what we call the horizontal. Horizontal is simply what? A row looking at this difference over the original. Any questions on how to go about the horizontal analysis? So basically, using the horizontal analysis, it basically examines two or more different periods. However, the trend is usually you need to identify the base year. The base year is usually stated, or otherwise the younger year. So the trend is simply any year divided by the base year times 100 when you're using the trend analysis. So we have been given a financial statement here, and this is an income statement that shows a series of years starting from 2013 to about 2017. 2013, 2014, 2015, 2016, and 2017. And so we want to come up with what we call trend analysis. So basically, what this income statement is showing us is a profit for the year. We have our income and our profit before taxation and the current tax and the profit for the year. And this is happening for the subsequent years. So now we want to use the trend analysis. Remember, the trend analysis is any year, the dollar or kwacha amount divided by the base year times 100. So our base year we're going to look at is the youngest year, which will always be 100%. So if we're going to look at 2013, so this is 2,300 divided by 2,300 times 100, we get 100%. Then we have 4,300 divided by 2,300 times 100, we have 183%. 6,400 over 2,300 times 100, we're going to have 2%. It goes on and on. We go to our profit before taxation. So 259 over 259 times 100 is 100%. 572 over 259, it will give you 221. Here, however, the trend is going down. We're showing that there's 19,000 over 259 times 100, we have gone to 8%. Here we have negative 136 over 259 times 100, we get negative 53. Here we have negative 270 over 259, we get negative 104. So in short, the base year that we are actually considering is the youngest year. Anyone behind so far with calculating the
Mr.
trend
Collins,
analysis?
let me just clarify. Mr. Collins.
Yes, please.
So this is over a period of 5 years, and then the earliest year is going to be our best year.
Exactly.
For the 4 figures.
Yes, for all the 4 figures here. So you discover that the youngest year is a base year, which is having 100% throughout, 100, 100, 100, because the base year is the youngest year. Unless otherwise stated, where the base year could be referred to, maybe 2015 should be taken as your base year, maybe in that case. But if it's not stated, the youngest year is your base year.
Okay. All right.
Any other questions at this point before I proceed? All right, so I emphasize again, like I did during lunchtime, that your reports, you need to take your time before you submit as a group. You need to understand this. That's why I was very keen to wanting to see what you covered with my colleague. So this will give you a picture of how the trend is moving. A trend is simply a pattern. So here you can see that the pattern here, it's going upwards, then from here it declines slightly. This one is from 100, it goes up, then it goes down into the negative. Then this one is 100, it goes the negatives and goes up, and goes down. So it's like a cyclical, it's moving like this, using graphs like this. So you can depict this using graphs that will show you the performance of the trend. So between our turnover, which is the sales, the gross profit, and the profit for the period, which is in white. So we want to now use a trend. So for 2013, okay, so 2012, it is showing you that variation. The sales turnover is high and it goes to our gross profit, then finally the profit for the period. Here we have the turnover, which is highest, and the gross profit, then followed by our profit for the period. But here it's gross turnover, which is high, and followed by the profit for the period, then now lastly, our gross profit. So this is just depicting a trend. Usually you can use graphs or bar charts to just show you the performance. You can tell to see how the performance has been moving. So using this trend, you can see that the performance is going up as the years are going higher. So we also have what we call the vertical analysis, which simply gives us a relationship on each item on the face of the financial statement to a specified base. So here we need to understand that the turnover for the income statement could be a common base. Turnover is the sales, and sometimes the total assets for the financial position or the balance sheet is actually the base. So when you're looking at the income statement, they're using the sales throughout. So I noticed in some of the reports that I was getting that others were using different bases. But here the common base must be the turnover when you're dealing with the income statement, and when you're dealing with the balance sheet, the base should be the total assets. So the formula will simply be, for the vertical analysis, if you're dealing with the income statement, our vertical analysis would be that each income item should be divided by the net sales times 100. And for the balance sheet, each balance sheet item should be divided by the total assets multiplied by 100. So if we're going to look at this example of the income statement, so to calculate our percentages or the ratios, our key here is we have our revenue here. All right. We also have our profit after taxes here. So we need to know which of these elements we're going to use when calculating our ratios. So vertical analysis here, like I said, our revenues are key. So we'll start with the actual sales to be divided into all the elements. So we're going to say 496 into 496 is 100%. 496 into 345 is 69%. 496 into 150, 496 into 10, 496. You divide this figure into each one of them to get the percentages times 100. So it will give you this arrangement. And when we go to the preceding year, we use this 518. So you divide 518 into each of these ones throughout, and the percentages that will come will be as follows. So this is what we call the vertical. Vertical means you consider the rows. A vertical is simply a column. So you're using this column going downwards. But when you're dealing with horizontal, we're using the base here. Horizontal means what? A row. We're going this direction. So in the horizontal, it is, and in the vertical, we're moving like this, dividing this figure into all of them. So this is how the percentage were calculated. So if your statements are in Excel, it is even far quicker and easier to just divide those figures as explained. So any questions so far? Are we together? Are we moving together?
Yes.
Yeah, so please, as you go into your groups, you need to make sure that you make the corrections that are needed, because there are a lot of bases that people will be confusing. So if I were to show you, because I made 4 copies and people are not discussing, and ensure that every participant is what? Contributing to the pool. So if we're going to look at your statements here using horizontal analysis, okay, we are dividing. How did we get this 17.17 if I were to ask? How do we get this 10.17? What are we dividing? How do we get this 10.17? Can somebody help?
We are subtracting 2019 value from 2020 value.
Good.
Then we divide by 2019.
Excellent. We get the change. We subtract this first. If it possible, I'd have added a column here where you get the difference. Then you divide that by this. That's how we got this figure. All right. Why were we getting a negative here? Because the 2020 is smaller than the 2019. So the difference, we divided by that. So when it's in brackets, what does that mean? It means there is a what? There is a decrease. If it's a positive, there is an increase. So this is basically how the horizontal was done. It was as straightforward as that. When using the vertical analysis, the key thing was what? Was the revenues. Okay. So the key thing was the sales figure, the revenue. So we've discussed that on the sales figures, we're just dividing the revenue itself. It's divided by that, this into each one of them to get the figures there. So now financial ratio analysis now is where we're going to use ratios that have benchmarks. So financial ratio analysis is a tool that is used to assess any ratios. The key financial ratios that we're going to look at will be used for benchmarking. Now, a ratio is simply a figure in relation to the other, a fraction of the other, this over that, this compared to that. So under ratio analysis, we have 7 key categories. We have what is called the profitability ratios, which are used to measure how the firm is performing in terms of profit based on the sales and the investment of assets. We also have the liquidity ratios, which are used to assess how the firm is able to meet its short-term debt obligations. The leverage ratios look at the extent to which a firm is financed by debt relative to its asset base. Efficiency ratios look at how the company is using its fixed assets and current assets to generate sales. And the market ratios or investor ratios are looking at the performance of the shares. These ones are pertaining to the owners of the businesses who want to see how you are faring in terms of the investment. Remember, we talked about internal users of financial accounting information being internal and external. The internal are, can you quickly remind me, who are the internal users of financial accounting information?
The managers and the workers.
Okay, the managers and the workers. All right. And who are the external users of financial accounting information?
The shareholders, the public.
Exactly. So these ratios also depict the types of users of financial accounting information. To start with, the managers are responsible for the efficiency ratio to be held accountable as to how they have been using these assets. To what degree have they been using the assets to generate sales? We also have the debt collection department, which wants to look at how the firm internally is using its debts to finance the operations of the business. Yes, debt is inevitable, but if a firm is over leveraged, it means it is over financed by debt, which is very, very dangerous. And also, we need to understand the examples that are found in each of these ratios. So under profitability ratios, we have what we call the gross profit margin. We also have what we call the net profit margin. We also have what we call the operating profit margin. We also have the return on assets and return on capital employed. So liquidity ratios, we have two. The two key liquidity ratios are, we have what we call the current ratio, we have what we call the acid test ratio, which is also called the quick ratio, and there's also what is called the cash ratio. Under leverage, we have what is called the debt to asset ratio, the debt to equity ratio, and the interest cover ratio. Then when we are looking at efficiency ratios, we're looking at the debtors days, which are how long it takes for our debtors to pay us. And we also have the creditors days, which look at how long our creditors will take to pay us. Then we also have the stock days, which basically look at how it takes for us to sell our stock. So we know that by keeping stock too much, it becomes a problem. Overkeeping stock may result to stock either becoming what? Outdated or expired, or would also have the tendency of having to bear a cost of what we call storage costs and handling costs. So keeping stock for a long time again is not very healthy. So we need to be careful in the way we analyze these ratios. Then we also have what we call market ratios or shareholder ratios, which emanate from the earning per share, which is EPS, the dividend yield, the market capitalization, the return on equity, and return on the total assets. So these are the 5 key categories of the ratios. So now we are going to go into the formulas of each of them. So if we're dealing with the gross profit margin, it's simply talking about our sales less cost of sales or cost of goods sold. This gives us what is called the gross profit. It's in short the gross profit over the sales times 100. The operating profit margin is simply the profit before taxes and interest over the sales times 100. We also have what we call our debt to asset ratio. It looks at how much ratio we have of the total assets to the debt. And the debt to equity looks at the debt, how much ratio we have to the equity. Then we also have what we call the current ratio, which is our total assets divided by our current liabilities. Our total current assets over the total current liabilities. The quick acid test ratio is the same formula except that it negates the what? The inventory or the stock. These ones have a standard benchmark of 2 to 1. Here it is 1 to 1. So this means that for every 2 assets that you have, at least you must have 1 liability. And we know by now that a liability is simply what? What we are owing. What we are owing. So profitability ratios really in the long run are very important because they are there to depict the survival and prosperity of an institution. So when we're talking about profitability, it's simply the ability that a firm has in generating more income to the expenses. So most of these organizations are there to make a profit. So if the profitability ratio is high, meaning they're able to cover or meet their expenses. So these profitability ratios are actually 5, like I mentioned. We have the gross profit margin, the net profit margin or the operating profit margin, which looks at the net profit before interest and tax. Here, the gross profit over the sales. Then we also have our gross profit analysis. So whenever you're analyzing the gross profit, you need to take note of the two key components. Number one, the level of competition. So it is very important that as you make your analysis, you comment it in terms of competition, because the level of competition is what brings about aspects of substitution effect. So if your gross profit margin is low, meaning the comparison between the sales to the gross profit is stiff, because customers are now able to compare between prices, and because of elasticity, customers may switch from one product to another. So if you're looking at brands, for instance, you're looking at Coca-Cola, and you're giving suggestions as to why there was a low gross profit margin, you should look at it in terms of competition, because sales really emanate from the competition that is there. And the product mix is simply a composition of the volumes of the products, the pricing, the branding of the actual product. So these ones really contribute to the sales. So you need to look at the brand itself. If you're analyzing a company like Aquavita, so for people to become more competitive, maybe you could even give suggestions of repackaging. If they tell you succinctly to say they sell water in 20-liter bottles, and you discover that within the trend, people are buying less of those ones. So you could perhaps comment in terms of the product, it being repackaged into smaller volumes where people can buy. So it is more than just an issue of figures, but an issue of what? Having an analysis of the trend, what is happening. So the net profit margin is a net profit before tax over sales. So this one incorporates all the expenses which are associated to the business, excluding the tax. So it is important to look at this ratio because it helps you analyze over time our ability to manage the expenses. If expenses are too much, it means our net profit will be small. Then we go to what is called the return on assets, which is simply the net profit before tax over the total average assets. It simply shows how much quarter is generated by the assets that are invested. So if we have a higher return on asset, it means that we are using our assets properly to generate our net profit. Other profitability ratios include the return on equity. This ratio, however, also falls under shareholders' ratios because we are looking at their equity which belongs to them. So it looks at the net earning that emanates from the investments that shares put in terms of equity. So the shareholders will be very interested in this because it will be vital for them to understand how much their assets are creating value. So we also have what are called the liquidity ratios. These liquidity ratios are also called short-term solvency ratios. They help gauge a firm's ability to meet its short-term obligations as they fall due. And so we have two types of liquidity ratios. We have the current ratio and the quick ratio. Current ratio simply looks at the ratio between the assets and the liabilities. These are the current assets and the current liabilities. In the previous chapter, we looked at the types of current assets that we have. Current assets are usually recorded in order of liquidity. At the bottom, we have what? Cash, followed by bank. Then we have what? Prepayment. Then we have what? Debtors. Then finally, we have what? Inventory or stock. So we're going to divide this by the current what? Current liabilities. And current liabilities include the short-term debt obligations, which may include accruals, which include the creditors, the short-term creditors, and the loans, etc., as long as they fall within a year. So when you divide the current assets divided by the current liabilities, we're going to get what is called the current ratio. Now the required standard is about 2 to 1, or in short, you need to have more assets compared to your liabilities. But when you go to the quick ratio, it just negates this stock and you divide these assets, current assets minus the inventory divided by our current liabilities. The importance of this ratio is that whenever a creditor would want to come, they will not want to consider the stock that you have because they want their money. You could easily get your cash or at bank, or if you overpay, that is your money, you can easily claim it. Or peradventure, you have people whose payments are due. You just call your creditors, your debtors, to give you the money that is due. That's why it is an important. And the quick ratio, the benchmark is supposed to be 1 to 1. So for every one asset, there should be one liability. Any questions at this point before I proceed? Any questions? Are we flowing together?
A question?
Yes, please.
I don't understand on the quick rate with it. 2 to 1, 1 to 1. Ratio. What does it mean?
Okay. So there's a benchmark. This is called ratio analysis. A ratio is simply relative figure to the other. For instance, if in 2021 and we have 2020 here. Here we have our assets as maybe 1,000 or maybe 2,000. Then here we have our, okay. So a ratio is simply dividing how much is in here to that amount. So here 2,000 divided by 1,000. Divide here, you get 1. Divide there, you get 2. So this is a ratio which is 2 to 1. It means we have 2,000 compared to 1. It's just a ratio. You understand this more as we look at the calculations. But what I mean by the benchmark is that whenever you're looking at the current ratio, you are advised to have, because this is assets to liabilities, you're advised to have 2 assets for every 1 liability. Here, for the quick asset, it's supposed to have maybe 1 asset to 1 liability. You shouldn't go below this. They should be at par. I hope that is a little bit more basic and clear.
Yes, thank you.
All right, then we also have what are called activity ratios, which simply give us a picture of how the firm is utilizing its assets to generate sales. And also we have activity ratios that help us calculate the period it takes for our debtors or our creditors to pay their outstanding balances. So if we're going to look at the debtors collection period, really, it looks at the period of time it takes for our debtors to pay us our money in days. That's why I'm applying by 365. So sometimes the longer the period it takes, it affects our creditors payment period, because the money that we're expecting to be paid is what we want to pay our creditors. So in your analysis, you need to also look at the duration of time. As well, on a business note, it's not advisable to quickly pay your debt so quickly, because that is the very simplest source of funding for a business for which you could have to generate more income. So there are people with the tendency of paying back if you're given a period of 30 days, all right, and you have money on the 3rd or 4th day, and because you want to show goodwill, you quickly pay it on the 5th day. Yes, it sounds so Christian, but business-wise, it's not, because that money could have multiplied or generated 3 times as much in a business. And so those that are in village banking, you have technically collection periods. And so you get your money 20,000 and your cycle starts the following month or after 2 months. And you want to quickly keep that money and just put it back without generating it. The essence of these are basically to grow your money. So you need to have a business idea into which you could pump in the monies. So in a nutshell, what I'm trying to say is it's very important to have a plan for the monies that are collected so that they could multiply. Otherwise, you would end up having loans in a business for which you need to pay interest. And that also has its own ratio. And we go to what is called the gearing. Gearing simply means the percentage of...
Mr. Collins.
Yes, please.
Mr. Collins.
Yes, please. Yes, please, I can hear you. Your network is really bad. I don't know whether it's on my side as well, but
does that mean that we're supposed to...
So you can text your question in the chat box so that I can really find it easy. You can text your question in there because you are really breaking badly. But all I can say is when you're also making a comment regarding the activity ratios, there's a benchmark to be given. For instance, the payment period for the data is 29 days, and these ones took 35. They went above the industry. And the creditors payment period, how it needs for us to take to pay, maybe it's 32 days, and we paid maybe at the 15th day, or we paid at the 40th day. So if you're making your analysis, 40th day is way above the benchmark. A benchmark is simply a standard. You'll be rated bad data to this creditor, and so you would not record well in the books. Okay, so if you pay too early, again becomes a disadvantage to the business because you deprive them of what? Easy sources of finance. So do we ignore the cash sales and purchases if given? Clarify. Do we ignore the cash sales and cash purchases? Yes, because when you're dealing with creditors and debtors, we're dealing with accounts payables and receivables, and here we're actually looking at these ones are debtors. They collected money on credit from us, so we're only dealing with credit transactions here. These are what? Credit purchases. These are credit sales. So in the income statement, sometimes we'll be given the sales figure and an adjustment that says of the sales figures that are showing us 10,000, 7,000 were cash sales. So you need to intelligently subtract and only deal with the credit sales. So yes, we're only dealing with credit transactions. Very good question. I hope that has been clarified. Any other question at this point? All right. Leverage is about the dependence on borrowing. Debt is a very detrimental asset if underutilized or taken advantage of. So if a firm's capital employed is financed by debt and predominantly by debt, it becomes a problem. In this bracket, we usually consider our preference shares as prior debt capital because these are not the owners of the business. And as such, whenever they invest in this kind of business, we are looking at financiers of capital as the creditors. So prior debt capital are preference shareholders that we look at. So if there are many of them who are just speculative investors who invest for the sake of a return, then it becomes a problem. So the lower the gearing ratio, it means you have a higher dependence on what? On equity financing. If you have a higher gearing ratio, it means your dependence is higher on borrowing, and it poses a financial risk and high volatility of profit. So the formulas that we use under our leverage ratios are the debt to capital ratio, the debt to equity ratio, the time interest end ratio. So the TIE is very important because it also looks at the number of times in a year that a company has earned its annual interest, the interest costs associated with what? With servicing a debt. So to the bankers, this is a very important ratio because it helps assess a firm's ability to pay their liabilities. Normally, bankers will be looking for a TIE which is 2 or greater to give them a very good picture. We also have market ratios like EPS, dividend per share, dividend payout ratio, and earnings yield. So these ones are very important to the shareholders who are the external users of financial accounting information. And we also have the price earning ratio, which is simply the market price per share over the earning per share. So the benchmarking are simply standards that look at the intra and inter-firm comparison. It gives you an industry benchmark, the competitor benchmark, and the benchmark within our industry. So it includes the interim, the industry, and the competitor, where you're going to compete. You may think you're doing well, and yet industry-wise, you are below par. You also may be doing well, but the company in the firm, you're not doing okay in the competitor analysis. So this is what is comprised in. Now, financial statement analysis has its own limitations that you need to know. So we must really be careful whenever we're dealing with financial statement analysis, because a strong financial statement does not necessarily mean that the organization has a very strong financial future. So sometimes it may be relative. And the other challenge is that it's usually based on historical data. And so historical data is usually obsolete. Things change. And also the absolute size of the ratio is meaningless unless it is used to compare it to a prior year industry and the trend analysis. You're able to see within the same proportion. So depending on the size of the firm, sometimes you may be performing well, but you're not doing fine on the actual sense on the ground. Then we also have intercompany comparisons, which are limited to how similar companies are. So these are the limitations for the intercompany. It limits you to how similar companies are. So you can only compare to a particular company within the same field. And the financial statement analysis may look good, but there are other factors that may cause a firm to collapse. So it is based on an algorithm that makes an assumption that these are the only factors that are there that will determine company growth, where there could be others that may be to management. They negate issues of human resource empowerment or motivation. So these ones are not encompassed in this financial, because of the non-financial aspects that may result to a firm going down. Then the last limitation is that there's need to consider a holistic view rather than just ratios, but other factors like objectives, strategies, like I mentioned. So we've been given an example, which I'll not look at because it pertains to the financial statement that you were given as an assignment. So quiz number 5 has the following questions. Activity or efficiency ratios. They measure the extent to which a company has enough cash on its statements of the financial position to service its current debt obligation. Is that true? No. The debt obligations look at which ratio, if I may ask? Which ratio is interested in this? The debt obligations? The liquidity ratios. Question number 2 is a calculation. Said calculations will be on Thursday predominantly. Then leverage ratios measure the profitability of a business based on the sales and investment in terms of assets. Is that true? No. If not, which ratio is interested in the profitability of a business based on the sales and investment? Which ratios are based on that?
Profitability ratios.
Yeah, profitability ratios, correct. So this is a calculation. We go to, this is also a calculation. We go to the interest cover. The interest cover is also called a leverage ratio. Is that true?
No.
It's not true. Yes. Interest cover. What is the other term for leverage ratio? Gearing ratio. Gearing ratio. So this is false. Excellent. And profitability ratios will exclude current ratio, gross profit ratio, return on capital employed, and net profit margin or percentage. Which one will be excluded? Correct, the current ratio are excluded. So we have 5 profitability ratios. Number 1, the gross profit margin. Number 2, the net profit margin. Number 3, the return on capital employed. Number 4, the return on assets. And number 5 is which one? Operating profit margin. Okay. This one is a calculation. So basically, this is what is involved in this unit. All right. Then it's very paramount that as you make your report, the report must be based on an objective view. So I will end here. Unless there are any burning questions, you can ask now or forever hold your peace.